Do you remember that scene from the movie Jab We Met, where Shahid Kapoor comes back from Manali, attends the shareholder conference, stands up in front of everyone and says, "Boss, साड़ी तो बैंड बजी है, इससे बुरा और कुछ हो ही नहीं सकता." We may not be there yet in the context of stock markets, but chances are we might get to that position sometime this year in 2022. We have been swept by an inflation wave throughout the globe. USA is seeing a 4-decade high inflation at 7.5%. UK is seeing a 3-decade high inflation at 5.5%, and Eurozone is seeing a all-time high inflation of 5%. This is not just restricted to these three geographies. 78 out of 109 emerging economies and 15 out of 34 developed economies have all seen an inflation as high as 5% or more somewhere around December 2021. With such high inflation, how can interest rates be left behind? Central bankers all over the world are either forced or tempted to raise their interest rates, and chances are we might see this trend catching up in the emerging markets, with India not remaining behind. With such bad news coming in on the inflation front, stock markets always respond negatively. To add to this turmoil, we are having a situation between Russia and Ukraine, and oil prices are touching newer highs every passing day. With all this bad news, now you get the Jab We Met reference. Hi everyone, this is CA Adit Shirvalkar. Warren Buffett once said, "Never lose money in the markets." That's the first rule of investments. What's the second rule? Don't forget the first rule. So that's how important capital protection is when you are investing in the stock markets or anywhere else. I can suggest 5 kinds of investments which will ensure that at least if we don't earn a lot of profits during this phase, we'll be able to protect our capital. Before we start, a standard disclaimer: this video is for educational purposes, and any recommendations or any suggestions given in this video are not to be treated as investment advice. You should always consult your investment advisor before making any investment. So let's now get right to it. The first investment option for capital protection is fixed deposits as well as postal saving schemes, both similar kinds of instruments. There are obvious pros coming out of this. The first pro is that these are flexible instruments, which means you can use these for short term as well as for medium term. The second point is that the instrument does not have any market risk, which means whatever you invest on day 1, you get the same amount on day 300 or whatever your maturity duration may be. On the con side, these are very tax inefficient instruments. Your interest gets taxed at whatever tax slab you are in, and the prevailing interest rates are pretty low, which means it may not be a very lucrative option if you are conscious about the return that you get over a low or medium term. The second investment option is ultra short term funds and short term funds. The pros coming out of this category is that the impact of interest rate risk is minimized. When interest rates typically go up, the value erosion happens faster for longer term tenure mutual funds. Ultra short term and short term funds, being short term in nature, they are relatively less impacted by interest rate hikes or falls. The second point is that these funds have outperformed fixed deposits over the past year. So while fixed deposits have typically prevailed over 5 and to 5.5%, many of these short term mutual funds have provided returns in excess of 6%. There are many cons, however. One con is that these are not tax efficient instruments, particularly for investment duration less than 3 years, because all the capital gains that you earn are all added up to your income and taxed at your slab rate. The credit risk is also moderate because many of these funds typically invest in commercial papers and other instruments. The third point is that these are all subject to market risks, which is an obvious caveat for many of the mutual funds. And fourth point is that these are suitable for short term investments only. So if you are having a medium term horizon, or you are bearish over a long term of maybe 2 years, not long term, medium term of 2 years or 3 years, these are not the most suited investments for you. The third investment option is corporate fixed deposits. Again, obvious pros over here: there is no market risk, there is manageable interest rate risk. The rates currently are better than bank fixed deposits, which is the third advantage of corporate fixed deposits. The cons, however, are that these are not very tax efficient instruments. Same way like bank fixed deposits, the interest is taxed at the slab rate that you fall in. The credit risk is also moderate, because while banks have a lot of restrictions from RBI to keep solvency, the same pressures or the same stipulations are not there for the corporates. Third point is that it is suited for medium term investments only, because if you notice, the corporate fixed deposits are ranging from 1 year to 5 years or 6 years, or in a higher tenure. If you want to keep your money for shorter period, then corporate fixed deposits are not suitable. The next category of investment option is target maturity mutual funds. What it basically does is it invests in debt instruments, and they keep that debt instrument until the day that it matures, which means they try to rid themselves of any interest rate hike or fall related fluctuations. The obvious pro is that the interest rate risk as a result of this structure is managed. The second pro coming out of this is this could be a very tax efficient instrument, and I'll explain why. The tax efficiency, if this instrument is held for longer than 36 months, is higher, because the gains that you get out of this will then become long-term capital gains, and they will typically be charged at a lower rate. The cons coming out of this is that this instrument has both credit risk as well as market risk, because the credit risk comes out of obvious default coming out of bonds, and market risk will come typically if you choose to redeem these mutual funds before the targeted maturity. The most important point is that this is an untested product, and whatever investments you may be doing, there you may be blindsided by a risk that you had not foreseen. The fifth and the last investment option that I have to suggest is specific defensive stocks. I am talking about stocks having large cash reserves. I am talking about stocks which are having decent dividend yields year after year, and there could be many other criteria based on which you can zero in on maybe 5 or 6 stocks which could be deemed as really defensive. They may not crack under weak market conditions. These are the kind of stocks that I'm talking about. Now, the pros of investing in these kind of stocks is that they are tax efficient if used smartly, because the duration for short-term capital gain for equity and equity-oriented mutual funds is 12 months, which means it could be beneficial if you want to make a medium-term investment of say 13 months or 14 months. It could be a very beneficial investment because it has a tax rate of 10% for long-term capital gains. Second point is that there is no direct credit risk or interest rate risk. The reason being that these are not debt oriented mutual funds, these are equity oriented mutual funds. So there is no credit risk as such, and nor is there any interest rate risk. So you are taking exposure in equities. Now the cons is that there is a very high market risk, as with all equity and equity oriented products, and it requires a lot of attention from your end. In case your stop loss gets triggered, then that's the point at which you need to rush into the market, sell that stock, and limit whatever losses you may incur because of that. So it requires a lot of attention because they are too volatile. The third point is that these are suitable for medium to long term investments. Short term investments in equity typically become, as I said, very volatile. So which is the best investment alternative of all these? The answer is not very simple. If you are an inexperienced or a new investor, or you're managing your own portfolio, your approach is like Pushpa, मैं advice नहीं लेगा साला. If your approach is like that, or you are in general not a very sophisticated investor, not trained in finance, then I would suggest invest in fixed deposits or ultra short term mutual funds. On the other hand, if you are the other kind of investor who is experienced, who is sophisticated, who is very well advised, then all the other options also make sense. You may invest in specific defensive stocks, you may invest in different kinds of target maturity mutual funds or other debt oriented mutual funds, which makes sense to invest. Your action point in this case would be to refer to your chartered accountant or your registered investment advisor, and you consult them for making your portfolio both tax efficient as well as gain a lot of capital protection strategies from their wisdom, so that you keep your capital protected during these volatile times. Quit being like Pushpa, go to that advisor, take their advices. This is the final word on that I have on this matter. Thank you so much.